All right. Good morning, everybody. Starting a few minutes early because I am streaming to the YouTube in a different way, and I didn't know how long it was going to take to get it set up. But that's all right. It gives us a few minutes to kind of take a look around at other things while we wake up. About 5 minutes, anyways. It's not that long. The market is definitely pricing in 75 basis point rate hike, which is part of the reason that we're going down. I'd already called the top of this bear market rally over the weekend, so it wasn't much of a surprise that we're going down at this point. It's nice to be able to put a finger on something or be able to point to something and say, this is part of the reason we're seeing those outward flows, or that soft selling pressure. And it was pretty soft selling pressure. I mean, if you take a look at what happened in the market yesterday, like the NDX, the NASDAQ, perfect example of a sideways market. Sure, some of the big dogs sold off, but the index is held. It's more that divergence that we've been seeing, the difference between market breadth, which is looking at all 100 names versus just the 10 names that are big enough to move markets. So what they've been doing here on the February series is decreasing that potential for a pause and pricing in at least a 50 basis point pivot. We ought to start seeing some performance chasing as we get into the second part of the week, the second part of the month. It's interesting about the seasonality side, though. I'm not a huge proponent of seasonality, but you can't argue the logic of it. I mean, I've certainly seen examples where it's been really amazing. Nothing works all the time, right? And I don't know. It's kind of like the Farmer's Almanac, kind of, right? You get some pretty amazing insight from the Farmer's Almanac, but take it with a grain of salt. But if we start seeing that performance chasing turn into an absolute rout, that could start a catalyst event into capitulation lows. So I started this stream a little early today. I'm trying to not use OBS software today, and Zoom has a built-in ability to stream to YouTube, but I didn't know how long it was going to take to bridge that and then get it all wrapped up and get it connected. But I think this will be the way to go from now on. So on Monday, we'll probably just start on time. Speaking of time, it's time. So good morning, everybody. So what we have on the screen is a snapshot that I had taken, kind of a little bit of a rundown on the end of the year situation right now. One thing that caught my attention is that bear markets don't generally have a positive year-end seasonality, right? Like Santa Claus don't show up on in bear markets. So no Santa Claus rally, apparently, statistically. And that's always the key, right? That in typical bear markets, there likely is not a Santa Claus rally. That doesn't mean there can't be one. But I didn't know that. I had never checked the seasonality of just bear markets when it comes to a Santa Claus rally. But the performance chasing of a lot of the funds, and I talk about it a lot, follow the money. Don't listen to what they say, watch what they do, because they will lie right on TV and say, oh no, we're in cash. We don't have any faith in this, and they'll be out there selling something or buying something. Or so follow the money. And what the money keeps showing is that there's still a load of buying going on, just a lot of buying. And until all of that exuberance gets wiped out, demand destruction is only part of the situation. We need wealth destruction. It's what the Fed has been working on, wealth destruction, mopping up all of that excess funds that they dropped out there during COVID. So if we see performance chasing start to get destroyed and they start throwing up their hands, a lot of these funds are going to get wiped out. So you're going to be wanting to watch articles about that, right? Articles talking about another ETF got wiped out or another fund got wiped out. And, kind of keep track of the AUM, the assets under management. 400 mil up wouldn't be a bad starting point. That might not seem like a very big fund, but the really, really, really big funds, it's kind of hard to see how many of those are going to get wiped out, right? It'll be the smaller funds anyways. Jobs are a really, really big deal right now. They are directly connected to wage inflation and inflation in general. And everybody seems pretty confident in what the numbers are going to be. And the more confident they get, the more nervous I get, because they don't know. The only thing they do is survey a bunch of people and they say, what do you think the numbers are going to be? What do you think? And well, after they ask 10 people, if they get the same answer from 10 people, then they're like, oh yeah, we know what the numbers are. No, they don't. They've been wrong before, drastically wrong, and been caught way off sides. If the numbers do not come in as projected and are opposite of the expectations, this market is going to leg down into year-end lows relatively quickly. Something from the presser at the FOMC when Powell responded to a question that was put to him about global sentiment of the accelerated pace that the Fed has been raising rates. He completely ignored and did not even give a nod to the global part of that question, and summed up what we're doing with: there's a need for ongoing rate increases. We have some ground left to cover, and cover it we will. And that's when the market really took off to the downside Wednesday, that statement. And we've been seeing them price since then to February and the December contracts. So yeah. It's a pretty light economic day. By noon, you're done. So anybody thinking about 0-day trades, once we're on the other side of lunch, it's smooth sailing. That rig count, I used to work on those rigs, and the number doesn't normally change by very much. I mean, we could get some crazy surprise, but we're not running a whole new fleet of rigs, so there shouldn't be any like recalls or rig shutdowns over, some design flaw issue or anything like that. And that can, that can really drop the numbers down. When they came out with the new flex rig systems, I call them new now, but that was a decade ago. When they came out with the new systems, they had design flaws on the way that the rig would walk to the next hole. And, that took rigs out of commission to get them fixed. So that one shouldn't matter, right? By the time you get done at 10 o'clock, it should be the last of it. And the rest of the day, smooth sailing. There are some anticipated speakers. We have Collins speaking today. And I mean, like right now, we should have a European central banker chipping their teeth. You can see that discussion about Chinese ADRs is still going on. China made it very clear to their state banks that they need to buy Chinese companies' stock. And the flows were kind of mild. So they must have gotten the whip, right? China must have cracked down on those banks and told them to pick up the pace of the buying, because the pace of the buying significantly increased yesterday or last night while we were sleeping. And now Bank of England is accelerating the pace of their rate hikes. They just accelerated in a way that's like the first time that they hit a level like that is in 33 years, I think it was. So I did close out my Google put yesterday, right near the end of the day. Seemed like a good time to do it. Start thinking about another position to build into. All right, so if you think about the cash session, we are inside day breakout, but only if we're talking about the cash session. We got it and then we lost it. Right, so just a little wick outside the box. But for the entire day, we're still inside day. When you're dealing with your trading day, it really does help to break it down into quadrants or zones. You know, I've only got two here and they're lopsided. The smaller one is on top. But we could make an argument to break this down into 3 zones or 3 quadrants based on the cash open and the high, the cash high of yesterday. So now we've got 3 quadrants. One, two, three. Breaking it down into quadrants or zones can really help out because you can focus on the individual pivots or levels within each quadrant. And they are their own pivot points too. You know, this is based on the cash open, and that's based on the high of yesterday, at least the intraday high. And there will be a reaction when we get to those levels. And we've seen that, right? We've seen it in the overnight hours when price responded here at midnight, here at 4 a.m., here at 5:15. So, you know, these are levels that price responds to. And so they can be broken down into, you know, more tradable activity. Gives you something to chew on in a smaller time frame. One thing that I like to do on Fridays is look at this weekly expected move indicator. And even though the market needs to close before this box is done, we usually get a pretty good idea of where we're at, right? And comparing what we got on the table for next week with what we did have on the table this week, you can see that the anticipated expected move for next week is much smaller than it was coming into this week. And that makes sense, right? We were coming into this week with the FOMC on the table. So the fact that we're done with that now and that they're decreasing the volatility a little bit kind of makes sense. There are some times where on the futures, this thing kind of acts all goofy and silly. But if that happens to you, just go over and look at the SPX, because it was actually designed for the SPX. It wasn't designed for everywhere else that we use it. We just use it everywhere else anyways. And you're still better off drawing these levels by hand. By hand, they will be way more accurate than this indicator, because this indicator cannot get to the data. And the data that it's reading is this data right here. That's where the expected move comes from, but it can't get there. So the designer did some math magic and got pretty close. But for all you wacko engineers out there who argue pretty close isn't good enough, do it yourself by hand. I need to go back to that chart for a minute. There was a discussion about overbought and oversold. I hate the phrase. I don't even like to approach the market from that point of view, but when I do approach that conversation, I approach it from how far away from the 10-period moving average are we? I have found that to be a much more accurate gauge for have we gone too far and has it happened too fast? And I think that's what we're always focused on, right? When we see a market make a big move in a single direction, we want to know, are we going to revert back to the mean? Is it going to pull back and go in the other direction, like a whiplash? Or, you know, when somebody stretches the bungee cord out to its fullest. So I use this little homemade indicator here, and all it's doing is asking how far away from the 10-period moving average are we? Right now, I've got it set on the weekly, and we're only about 1.5% away from the 10-week. We're underneath it, and we're not very far away from it. So have we moved to the downside too fast? No. Have we gone too far? No. We have a lot of room that we could fall before the market would even consider that we're oversold, right? That's the phrase that is usually used out there. Oh, we're oversold. Not even close. We have plenty of room to the downside. We'll flip that over to a day instead of a week and ask the same question. So we're underneath the 10, but only by about 1%. And the pause or reversal or oversold level, if you want to use that word, is around 3.5. Well, if we're only at around 1% and the average is around 3.5, we are not oversold. We can move a long ways to the downside before that would even begin to happen. Not quite sure I understand that question. If you're going to trade stocks, then use the marked pivots on stock. Do the same thing. Unless you're trading in a highly correlated market environment. And I mean highly correlated, like 98, 99% correlation. Otherwise, you're going to want to trade. You're going to want to mark your pivots on what you're trading. So we're not oversold for that discussion, right? I will argue that we were overbought, right? When we came into Friday's close and into Monday, and I started making the argument that the bear market rally was done, we were well oversold at that point, sitting in reversal territory. Volume on the day, it is normal, right? Well within the boundaries. We're not really, really low, which would cause concern because there's no reason to be really low. And we're not really, really high, which would cause concern because there's no reason to have really high cumulative volume this morning. That's all we use this for. So then just turn it off and get it out of the way. So I mentioned pivots earlier. You can see that there are a lot of pivots between the daily pivot, the cash open of yesterday, cash high of yesterday. If you're intraday trading something else, it will also have an open from yesterday. It will have a cash high from yesterday. It might even have a Globex high and a Globex low and a low of yesterday. Those would be the same pivots that you would mark out. But if you're an options trader in the current market environment, there's not a lot of liquidity out there in your normal names, right? Disney, Walmart, AMD, NVIDIA. The options liquidity is rough right now. I mean, it's not beautiful. So if you're struggling to trade options on an intraday basis, trade the easiest thing that there is to trade right now, Apple and SPY. They're the two most liquid things out there. And you can use Bookmap. I mean, it doesn't get any better than that. You don't have to buy it. It's free if you're using it to trade Apple, right? So why not? We have a market maker move this morning on the S&P, 46 points or 1.23%. So 2.6 and 1.2, that's 3.8. Throw the little rounding in there, 3.85. We could have a move today of more than 3.8%, and it would not even be considered an outsized move. That would just be a shrug. So if we want to measure that distance, we'll start at the Globex open. $3.85 gets us to 38.72. That's really close to this 786 retracement level, 38.80. And I'd just rather aim for that. It lines up. So I'll take it. 38.80. It's the 786 retracement. And 35.80. Well, that makes sense. All right, so there's the extremes. 38.80 and 35.80. I do not know. Creed was using Bookmap before he left in his live streams, and I think he did a couple videos on it. The thing is, there's a ton of videos about Bookmap, but it's about Bookmap the application. Like if you went to Bookmap and you downloaded the software and got a subscription, and that's a different kind of Bookmap. There's not a lot of videos, at least the last time I looked, anywhere on the web that did a really good job explaining the Bookmap that you find on Thinkorswim and then how you can use it. But literally you push the button right there and it's going to ask you, what free market do you want to look at? And it doesn't have a lot of choices for free markets. I think it's Microsoft, Apple, and the ES futures. Pick Apple. And there you go. So if you don't know how to use Bookmap at all, probably going to want to start there. And then how do you use Bookmap for Thinkorswim? Maybe check for Creed's videos, because he might have done a walkthrough. Maybe. I'm not 100% sure. There are search features on the website though, so you can go over and, you know, use the search bar in the upper part of the upper right corner. Start hunting around and check the free YouTube, right? Go on YouTube, type in bullish bears, type in Creed or Bookmap or some phrase like that and see what pops up. So the expectation today that we're going to just hold the line makes a lot of sense, right? This market doesn't owe us a leg down, and it certainly doesn't owe us a rally. And my base case argument for today is that we're going to hold the line. We may peak outside of yesterday's levels to the upside, and we may peak outside of them to the downside, but I'm not really expecting any catalyst event coming in. And I'm not expecting, you know, any sort of rebound rally, and certainly not a continuation lower yet. Of course, that can all change when the numbers come out today, and any news or catalyst could kick that off. But without that, I think it's going to be a boring, choppy, sideways Friday, with the only expectation being that we don't crash and burn any lower, and that we also don't rally back up hard. That should be real easy to benchmark, because if we're still inside of yesterday's price action, then we're not going anywhere, right? I know how Captain Obvious that sounds, like, gee, thanks. But seriously, if we're inside of yesterday's range, we're not going anywhere. So we can run really hard to the upside, but as long as we're still in that box, we're still in the box. Same thing with a run to the downside. As long as we're still in the box. And wicking outside of it wouldn't count. You're going to need like a candle close, at least say on a 15-minute time frame, or a definitive breakdown that sticks, right? Say like yesterday when we had that huge move to the downside and it didn't stick. It just bounced right back up again. 2 15-minute candles side by side. So, you know, it can be violent and we can shake around quite a bit, but until we definitively leave this range with conviction, my base case argument for today is that this is going to be our day. $10-day, 30-minute volume profile with TPO. We have this really nice shallow area on the TPO. And there's nothing really here on the volume profile because it's all over our head. And there's just a lot of trash that still needs to be cleaned up. But the good thing is as we work through the day today, these candles here on the left are slowly going to disappear. And what we'll be left with is coming in on Monday, this collection near where we are now, right? We won't have any of these lower levels anymore. Probably nothing below 3,700 or somewhere around in there. When we're at the top of the box, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. We talked about this when we double topped the other day. Point of control is over our head. So if we were to start taking that rally to the upside with that measured move that we have, we would have to get through the point of control first, which it would be a very difficult thing to do. It's doable, especially if the catalyst that moves us in that direction is big enough. And there is a catalyst, like there's something on the deck today. And we know that there's something on deck because the market maker move is there. It wouldn't be there if there wasn't something concerning in the horizon. And it's the job numbers, right? It's not some secret. So once that's gone, we should see the market maker move drop off, and that will eliminate these two very wide pivots that I marked out, and we'll be back to just our normal day of pivots. 5-day, 5-minute volume profile. Talked about it yesterday. There is a profile lower with this VPOC, but again, it's, pretty far away. It's doable. It is doable that we could get there today, but it would require, a substantial, significant move. And there is a VPOC over our head as well. Both are within range thanks to the market maker move that we have this morning, but the expectation is we won't see them today. I mean, they would have to really miss with those job numbers for us to see those levels today. Markets don't move in a straight line. We are due to cycle back through, right? Cycled from the high down through the low. We tried to cycle back up and that got blocked. We reset and tried it again. Look at it through the year. We've just been working our way down. Right? Above the line, below the line, and it reciprocates. So if you get 2% on one side, you get 2% on the other. 1% on one side, you get 1% on the other. But not in a straight line. So it's between now and the next 2 weeks, 2.5 weeks, that we get back down to that 3,600 level. And then we start considering where the new leg down is going to be. You want to continue to watch US dollar Japan and US dollar China. It's the same thing that we've been talking about all week. We want to see this currency pair go down, which would see the dollar go down, which would see the S&P and the NASDAQ go up if you're a bull. If you're a bear, seeing this go down is not going to be in your best interest, right? So US dollar Japan running to the upside, getting a little out of control, kind of like what US dollar China. These guys kind of been getting a little bit out of control. It is getting a reasonably decent pullback now, but it was nearly untethered. So seeing this pullback, this is good. That it's kind of keeping the dollar in check a little bit. But if it turns around and starts going back up and the dollar starts going back up hard, we could very likely leg down. Right, so we came up into that pivot point. We're kind of still dealing with it, whether we're going to make it through there or not. Remember, it's not about a line in the sand, especially a very thin pencil line. It's more of a fat crayon drawing kind of zone or an area. We need to see the dollar get through that 113.5, maybe that 114. If it breaks above this current pivot structure, and I mean, not just wicks up there, but actually breaks through it, then we're going to start to see things unravel a little bit on the downside. Above 114 is levels of risk. You can set alerts either using the Discord or just literally right-clicking on your Thinkorswim and create alert. It'll text you, it'll email you, it'll ping your smartwatch or your smartphone, send you a message, and it also messages you right here on the platform. It'll do whatever you want. Custom alert noises and sounds and everything. But on the Discord, you can just use /alert and set up an alert for yourself. 114 and above, start getting concerned. We break above 115, you should already be short the ES, short the NASDAQ, short Apple, short Google, short everything, short it, sell it, sell. Get it while the getting's good, right? Because as soon as we pull back down, when we wicked up there before, it didn't last. Right? We got right up into it, dumped right back out of it. So, we're not talking long-term trades here. The gap up in the 10-year yesterday was significant. It is eye-catching. But we did fade through the day afterwards. It's why the candle is solid green when all of the other candles are hollow green. It's because it closed here, it opened here, and it spent the day falling. But it's still green because it closed higher than it opened. And I know it closed higher than it closed the day before. And I know this might sound like simple stuff to all the normal traders, but hey, we were all new at some point, right? So from the idea of just yesterday, sure, it was a down day because we opened, at 41.9 and dropped all the way down and closed here. That's a down day, should be a red candle, but it's green because it was still higher than the previous day's close. That's why I use these candles that change color based on where the open and the close resides within. Otherwise, if you do it the other way, just candles, then they're all going to be solid and you don't know where we opened or closed. And then you got to hover your mouse and look up here where all the numbers are at and try to figure out what was going on that day. On the 10-year, we really want to see this calm down a little bit. The gap up now needs to be resolved. Wouldn't be surprised if we resolve it today. If we go into the weekend that way, and then we open up, well, let's focus on it another way. The concern will be if we gap up on the week, right? So, kind of consider where we could close this week. And my concern is if we get back up into this area today, and then we close up there today, and we gap up into that 42 area Monday. That's been one heck of a run, right? Too bad we don't have a lot of really great liquid option stock trades that had markets that look like that. Well, that'd be nice. So watching this morning for a gap fill, again, if this goes up, then, you know, it's putting pressure on the market. Expect the S&P and the NASDAQ to struggle with any moves to the upside. It's not that they can't move up. It would be the idea that if they move up with this moving up, something would have to break, right? It's a significant resistance against that. We're still in sell the rip mode. So if there are any rips to the upside today, you know, kind of think about if that's offering you the structured opportunity to get in for a new short. That's what last 2 weeks, that bear market rally from October 14th all the way up into Monday, that was all just another leg up so that we could jump in with our shorts and run it back down again. UNG's up a lot this morning. All right, so we might be getting a red to green with an inside day breakout on UNG. That'd be a nice play. So the resistance is going to be the previous day. You can see that the gap is not closed. Come on, Thinkorswim, let go of it. So we did not close that gap, and that leaves it on the table. This morning, it's closed. We are up there now, but it's pre-market, so it doesn't count. Right now, this morning, we're sitting somewhere up here. This is a red to green because we closed way down there. So it did that. And this is where we're at this morning. That's a red to green and an inside day breakout. The problem is this is, you know, a downtrending market. We want to see a red to green on a pullback in a trending market, right? We want something like this and that red to green right there. Because look at the outcome. I mean, look at the size of that green candle on that red to green. That's a phenomenally huge candle. But it was part of a trend to the upside. This, I mean, it's a double bottom, and that's nice. That's great. We could get a little something, but, you know, we've got this structured range here that needs to be resolved. So watch the $20 mark as we come into the open. See if we can get above this highest pivot, 2058. I would call it 2050, just forget the 8 pennies. If we can get above 2050, we'll start focusing on this gap close from back here, this $22 area. But more than likely, what we're going to see is a gap up, fade down, right? Fake breakout, fast failure, and dump right back down in again. But, you know, I don't know. Let's let it play out this morning and see. For a trend trade, the head and shoulders measured move is done. We could see this double bottom play out with a retest back up into the 30s. It's going to take a few months to get there. You know, we're talking about like through Christmas. And it makes sense that after the midterms and the energy suppression, that we could see that start to pick up anyway. So building a long position in nat gas would not be out of line for a nice swing trade. I'm going to do more work on this over the weekend and see how big of a position I want. But yeah, that's a good one to think about. All right, emerging markets are up this morning. That is a risk on indicator. It's like it's overly heavy with China stocks. So you got to be careful about that because China stocks are getting bought because the state banks were told to buy them, not because anybody really wants them. Metals and mining. I'm really sick of that catalytic converter story that's going all over the place, right? Like they're so proud of themselves. The Feds caught people that were stealing catalytic converters. Yay. Out of all the criminal enterprises out there, you guys shut down a metals theft ring. Hey, it's a start, right? Nothing here on metals and mining. We've got a broken trend line, so a TRB. Otherwise, we're sitting in the middle. We're not at the highs, we're not at the lows. There could be something here for a day trade, but K-Web. There was a UOA sweep last week, but other than that, haven't really seen much. This is another example of China. Only I use this one more for short float. You know, if we're going to see names like the GameStop crowd and short interest rally, short float rally, short squeeze rally, gamma squeeze. So far that I can tell, it's just the same thing. It's the China ADRs getting bought, state banks. Neo, Baba, Baidu, PDD. These are all great shorts, right? It's the idea that they're only getting bought because the banks have to buy them. China told their banks to buy them and they don't have a choice. They're great shorts from that idea, but you'd want to wait until the flow stops, right? Otherwise you're buying or you're trying to short it while they're still buying, and their buying can last for a while. I don't know how long it's going to go, but it's not going to last. All right, so for today, if the expectation is that we hold the line, they want to be looking for a gap down or a gap up in the SPX, see if we're going to get through yesterday's high or low. And with that, that it actually sticks, right? That it's not just, oh, well, we wicked down through that level, get a double bottom, and then we rally back up. Be very careful of a double bottom on deck here. Where we open is really important. I know it's a pivot that a lot of people overlook, but when the S&P opens, mark the open. It's the very first thing you should do. And then when we revisit that open through the day, if we do, which I would expect if we're going to have a range day, we're just going to chop through these levels. That the more time we revisit a pivot point, the less value it has. So if we go through the open a couple times, it won't really hold much weight, but mark the open, focus on these 6 pivots or 5 pivots, and keep that expectation that we're just going to maintain the range unless the job numbers are just way off their mark, in which case we're going to pop hard up or we're going to leg down significantly. With this gap not filled, it's the reason I left 37.60, right? This close from Wednesday. I left it on the table because it's an unfilled gap that needs to be filled. And it would not surprise me at all with the S&P up this morning that we open gapped up and we break outside of yesterday's range, which would typically cause a lot of you to buy. Like, yeah, baby, inside day breakout. No, not if we're just going to whack our head against the close of that, close the gap, maybe overshoot it a little bit and then dump right back down again, which would be a beautiful place to put on a 0-day spread, say like an at the money call credit spread, just to watch it dump and leave your credit spread sitting up there nice and safe and profitable. At which point you can close it or you can start rolling it down, getting more credit. Because if we reject there and we go all the way back down to the lows, you can roll it down. Just don't roll it down lower than that open from the previous day. All right, because that will put you into rebound risk where price comes down to the lows, rebounds near the end of the day and runs you over. So don't go lower than that. Not a lot of really good stuff for earnings today. The earnings from PayPal was like, kind of like what everybody says. PayPal doesn't normally have, crazy wild earnings. Revisiting the lows of around 70 is kind of in line. I wouldn't want to do it today since we've, red candle rule. We've gone way too many days at this point to want to try to take a short now. I'd wait for a pullback first, but I'd still target that 70, 68, 70 area. Tech and finance are really close together this morning. I see them spread out a little bit more as we come into the open and see if we get any divergence on those two. There's a leading indicator of warning too. We've seen that a little more often recently, where Bitcoin starts making the move that the market sentiment changes to. So it's not that I'm saying the market's going to go down that hard, the S&P and the NASDAQ. It's the idea that if this is, say, a sentiment indicator, a gauge for risk on and risk off, that is a risk off maneuver right there. And it kind of bodes against the idea that we could have an inside day breakout that sticks, at least unless the numbers come in crazy. All right. Nothing there. So I'd say, guys, have a good weekend. Be careful, be safe. I will see you all on Monday.